Welcome to the Daily Brief, where I'll go over the action in the market for Wednesday, February 8th, and then we'll see how things look for Thursday, February 9th. We had another down day. We're still positive overall. The charts are holding up fairly well right now, but we have to ask the question, is weakness starting to enter into the market? We just have to be mindful of that right now. If you think back to the beginning of the year, when it seemed like the market was going to go down, but then it went up, we saw some strength starting to sneak in from the sidelines and then push prices higher. Well, we're kind of seeing the opposite of that right now. We still have this positive backdrop that we're working from, and that could easily come back. But we're also seeing some things just kind of sneak in right now that are causing a few little warning signs, and I'll go through those in the video just to be mindful of that in case things do really switch more to a negative slant. So let's go back and talk about what happened. Right at the open, we had a gap lower open. Prices pretty much moved sideways before falling below the daily pivot at 41.43. We did not get all the way down to S1 at 41.09. We stayed above that. As the day went on, prices pretty much chopped sideways for the rest of the day. We were down 1.11%, and we dropped a bit in volume. That could be positive. We had a down day on below average volume. In a general sense, what we've been seeing lately is on up days, we see an increase in volume, and that's positive. So when we have a down day on below average volume, that can be taken as positive as well. As I stated, our technicals are still positive overall. They're hanging in there for right now, but we need to be a little bit careful. Inflation and interest rates are still the fixation of the market, which are feeding through to growth concerns as well as the EPS and valuation concerns. We want to keep an eye on all the geopolitical events. And then earnings. We're still in the middle of earnings season, so we'll be having a number of reports coming out. We may get some Fed speak on Thursday, but not scheduled Fed speak. There's another speech coming on Friday, but this might be interviews or just statements that are made. And then there's the debate going back and forth about the debt ceiling, which really is not getting handled currently. Here's the intraday chart showing how we gapped lower right at the open. We chopped sideways right after the open. Then we eventually fell down below the daily pivot, and that's when we saw the real weakness coming into the market. Down here is S1. We did not get to that level. We got a little close going into the close. We pretty much chopped sideways for the entire day. What are some comments that we can make? The State of the Union, it didn't really have that much of an impact. General rule of thumb is that what happens in Washington, D.C. is mostly seen as theater according to Wall Street. So there's a lot of talk going back and forth, and until something actually gets decided and passed, the markets, they pay attention to what's going on, and they might ebb and flow a little bit, but it usually doesn't have that big of an impact. But it was certainly interested in what was being said concerning the debt ceiling and the possibility of some increased regulations. Now, we have a split Congress right now, so that seems less likely, but anything can always happen. We need to keep this basic question in the back of our mind. Is weakness starting to sneak in? And I'll show you some charts that go through that. On a short-term basis, we still have our longer-term, short-term stochastic that's overbought. The short term and the intermediate short term, they've pretty much worked off their overbought condition. In the intermediate term, we still have the CCI. Now it's coming down, but it's slightly in extreme positive territory. And then on a long-term basis, we still have our moving averages, which are rolling over, but haven't come back down yet. The dollar declined and interest rates were also down. We still have all of our yield curves that I plot that are inverted. Sentiment is still positive. We slipped from being extreme positive where we had a reading of 78. It's now dropped down to 74. I'll look at the economic reports on the next slide. As far as our trend, the ADX is still positive and we're above 20 and the green line's on top. But if we have some significant downward movement, it could kick that ADX back down underneath 20. But for right now, it's not there yet. Our bias is negative, and our momentum I'm keeping at mixed for right now. The economic reports that came out, we had the weekly MBA mortgage applications index. It was up 7.4%. Last week, it was down 9%. And wholesale inventories were up 0.1%. They expected it to be up 0.5%. And last time, it was up 0.9%. So this was weaker than expected. And these were the only economic reports, so not a really big day in that realm. Here's one indication that we might be seeing some weakness. A lot of times we use this chart for our possible positive scenarios. I'm not looking at the price area as much. What I'm looking at is volume, where we really spiked up and went extreme positive, and now we're dropping back down. We're going to be keeping an eye on this. If price and volume both drop below this zero line, that will turn things back more negative. We had the weekly American Association of Individual Investors. They came out with their survey, saw a little bit of an improvement over the last week, but we're still below zero. We're not giving an extreme reading right now, so we don't pay as much attention to this except when it gets to extreme positive or extreme negative readings. The Ulcer Index still suggests that fear is not all that present in the market. We turned up just a little bit with this indicator, but we're still very complacent. This is also reflected in the VIX. Even though it went up on a closing basis with the down day, we're still below 20 overall, and we're below these moving averages. On the bar chart, we didn't close right at the high for the day, but we're seeing just a little bit of a tick up, but it's still showing overall complacency. Here's the VIX of the VIX, which this did spike up a bit. We saw a real move up on the bar chart and on the line chart. This could be suggesting that volatility is starting to pick up. We're just not seeing that yet in the VIX itself. Here's our trend. The ADX is above 20 and above the moving average and going up, so that's a strengthening trend. The green line's on top, so we default to that. We also saw selling really decreasing in the latest reading, even though we had a down day. The daily chart shows we came right up to this R level, which is also resistance. So we have a double layer of resistance at this level, and the market's having a hard time breaking through that. So far, we're still above the December highs. If we fall down below that, that will turn much more negative. And then there's this other level of resistance, which could potentially provide support. Now, overall, though, we're still positive. We're above this trend line. We have a recent golden cross. So that's looking better. But we want to watch this if we really start to fall. At the bottom, you see where volume dropped to below average. The moving average study is just showing a decrease in the 20, 50, and 200-day exponential moving averages. So that's a little bit of weakness. Not necessarily a surprise because we had a down day, but we'll just want to be watching to see if this continues to fall. The stochastics worked off the short overbought, intermediate overbought, just barely below this line. But the long-term stochastic is starting to roll over, but we're still extreme positive. The slope starting to turn down a little bit. We haven't really moved away from that moving average, and they have a tendency to be on top of each other. All of our other oscillators are still positive, but there's one that I want to show you, the PMO, where we have additional studies to suggest, again, that we might be seeing some weakness. Here's the PMO study, where the PMO is still doing okay. It's rolling over a bit, and it's looking a little extreme positive, but it's still positive nonetheless. When we look inside the PMO, based on price, we're starting to roll over, and based on volume, we're rolling over, but we haven't crossed down below the moving average yet. And sometimes these two bottom indications lead what happens in the PMO. Here's another study showing the PMOs that are rising is starting to decline. The buy signals are declining, and we're rolling over a bit with those PMOs that are above zero. The BPI is starting to come down slightly after being at 70. A lot of times when we get to 70 and above and start to roll over, that can mark the beginning of some weakness. The NYSE Bullish Percent Index, after breaking out above the August highs, is now starting to roll over, but not showing an awful lot of weakness, at least yet. The parabolic SAR. This was the warning flag that I saw before yesterday's video, where we had a dot on top even though we had been going up. And that's kind of a strange thing, and that had me looking for other areas of potential weakness. We're still seeing the dot on top with the parabolic SAR, so that has actually turned negative. The chicken money flow is showing a decrease, but still holding up overall, but we're below this moving average. If we see some more downside action in the S&P, this will continue to fall. The CCI based on 20 periods, just a little bit above the extreme positive reading, but it is declining. The CMB Composite Index has now had an official sell signal. It crossed below the red line. That was the trigger, and then it's confirmed when it crosses the other line, in this case the green line. TTM squeeze still showing darker blue bars, and that is still positive because they're blue, but it is starting to decline, and we're turning back to more neutral because the bars are darker colored. Our fib levels on the short-term basis, after getting above the 100% retracement, we've now fallen back below that. Longer term, going from the all-time high to the October low, we're having a hard time getting through this 50% retracement. We get a little bit through it and then come back down. Get above it and then come back down. So we've been teeter-tottering right around this 50% level. Longer term, we're still below this 42.13 level. That's quite a bit above where we're at. And we're still above this 40.20 level. So we're in no man's land on this chart, with potential support if we fall and resistance if we continue to climb. The Swindlen Trading Oscillator based on price is now dropped below zero. Based on volume, it is declining, but not below zero yet. Moving average tree, we're still above all of the moving averages. The Elder Impulse system continues to be neutral. It has not switched over to negative, at least yet. McClellan Oscillator dropped below zero. It had dropped below zero after Monday, only to come back up on Tuesday. Well, on Wednesday, it now dropped back below. And that's starting to impact our summation index, which is rolling over based on price. And another telling sign here is that we're rolling over based on volume as well, but we're matching this previous high before we start to turn back down. And this is a pretty extreme positive reading. New highs, new lows. Our 5-period moving average is just about ready to cross, and we're seeing the 10-day differential start to decline. So far, the advanced decline line is holding up. We're above the moving average, even though we saw a decline, and we're above the moving average based on volume. The cockpit curve is still giving us a valid signal after the signal that was generated in early January. If we continue to fall, this will probably roll over. Doesn't mean we can't still use this signal. It just means the buy signal has gone away or exhausted itself. We are seeing a real drop-off in volume where the black line is dropping below the red line and the histogram is also declining. The longer-term moving average study, we're coming down off the 50, but what we're really watching lately is the 150. Even though it's coming down, it's still above this extreme level, and the same thing is true with the 200-day simple moving average. The diamonds have switched back to neutral. They've been just jockeying around pretty much sideways. Going back to last fall, the diamonds or the Dow were really the leadership. They were going a lot higher as the market really wasn't following through. Well, now the Dow is starting to pretty much tread sideways. The Nasdaq is also having a hard time getting above this R1 level. We were able to get up above it only to fall back down, and we're currently right down below this level. And the same thing is true with the Nasdaq 100. Looking at the Elder Impulse system for the Qs, we still remain in neutral. The small caps, after getting above R1, has now started to come back down, even though we're positive because of the recent golden cross. The mid caps, after hitting this upward resistance, have been retreating. The home builders pretty much following what the S&P is doing. We've been down with the S&P, so the home builders were down. The ratio continues to decline, more or less together. And if you look at the bottom, there's a real strong correlation between the S&P and the home builders. We're not seeing any real divergence right now. If anything, it's a convergence because they're moving hand in hand with each other. Looking at a few of our possible positive scenarios, we're still positive longer term when we look at the 50-period exponential moving average of the highs minus the lows. This is a moving average of the 50-period exponential moving average. So we have a moving average of a moving average, which I know that breaks a lot of rules, but this has been a fairly reliable indicator, especially in the long term. Here's that same chart, the black EKG looking line. That's the 50-period exponential moving average. The red line is the moving average of the moving average, and it still shows that we are positive. This is another one that's a little bit concerning. The 10-day average of the highs minus the lows, we're still extreme positive. We haven't moved all that much recently. This looks like it could be at an exhaustion point. It has been now for a few days, and we'll want to see if this starts to decline. On a positive side, the S&P still continue to outperform the utilities, and that gives a lot of support to the S&P. If this starts to go back down and the S&P goes down, that will start to confirm the move. We're still looking viable with our staples to S&P 500 ratio. After really spiking up and coming back down, it's still continuing to fall. So that could be positive and often give some really good support to the market. So our outlook then for Thursday, the technicals are positive and we're above support. Are we developing some weakness? So we're watching for that right now. On Thursday, we have weekly jobless claims, and that's it. We keep an eye on all the geopolitical events, the same ones that we've been watching now for quite a while. Any one of these that are in white could quickly come into the picture at any time. The yellow ones are ones that are more prevalent at the current time. Looking at the stock market almanac statistics, the one I'm really going to focus on is how do things look for February 9th. Well, when we look at the Dow, it's up a little bit more than half, and the S&P a little bit more than half. The NASDAQ has a little bit more positive flair to it, being up 57.1% of the time. So we're kind of in that neutral area with a slight positive slant. Then these other areas I talk about periodically throughout the videos. I won't really discuss them here. We don't have any Fed speak coming out on Thursday, but we will have a speech that'll be coming out on Friday where Governor Christopher Waller will be speaking. He's not the Fed chair. We really pay attention to this when it's Chair Powell speaking. Our scenarios can't really go with the downwind yet because we're still positive overall and we're still above that support level. So if we do start to fall, that may catch prices falling. And of course, we have the positive backdrop, so things could easily go up. But we're just looking for weakness right now. Can't really go with the up one, at least yet, because we're starting to see some potential weakness. We had a down day. So even if you were looking to go long, since we had a down day, you would not have initiated that position. We're kind of still going with the sideways, even though the ADX is above 20. We've just been chopping around lately. And it is positive overall for the ADX, so we default to the positive side. So our conclusion, the S&P is positive, it's above support, we're watching for a possible reversal. At first, we're just looking for weakness, and then if that weakness starts to build on itself, that will turn into an actual reversal. Short term, we're still positive, but showing some weakness. Intermediate term, is weakness developing? Long term, we're still positive overall because we're above the 200-day simple moving average and we had a recent golden cross. Thank you. I hope you found this helpful. I hope you have a really good day and I will talk to you in the next video.